Good morning, everybody. Thank you for spending time with Jack and I. It's very important for us to share with you our views. Confused, dazed, unhappy, but have seen this movie before. And I think that's the good news. Have seen this movie before. We've been here before. Obviously, so much has changed in the last couple of days. And I will say the good news is a lot of damage has been done to the point of extreme, to the point where I'm expecting a snapback at some point very, very soon. I'll let Jack talk about some work he was shared with from a fellow named Sandy McIntyre. He's a strategist of 50 years. He's about 75 years old, and he comes on our radio show frequently. He used to be the head strategist at CI Funds. Slack's very smart man. So he'll share with you thoughts on that. But the first slide that we're sharing with you, I've showed this to you every presentation. It shows you intra-year declines for the market. Those red dots that you see across the bottom of the screen is how much the market fell in each of those years, and the bars show you how much the market actually made on the year. So the intra-year decline is the red dot, and the black bar is how the market or the market finished the year off. 3 to 4 years, the market's up. 1 out of 4, the market's down. That is the way it works. Things obviously have changed and continue to change. It appears to be a work in progress. I'm not here to predict Donald Trump. I am saying all of us making a lot of money right now. They don't like it. I can assure you of that. But the world has changed, as we do know. Here's a history of tariffs from the CI Global Asset Management going back to 1895. Tariffs have been higher. Tariffs have been lower. Tariffs are going to spike up to this point, according to what has been tabled from the president. And again, that's a watermark as long as there's no count, we've been told, and that can get negotiated back. Donald Trump speaking with China, putting TikTok on the table. Give him TikTok and he'll get rid of the tariffs. TikTok has to be worth, I don't know, $1 trillion, maybe $500 billion, probably about $500 billion. What do you think, Jack? What's TikTok worth? It's worth a lot of money.
I think that's a good guess.
500 billion. Yeah. So it's amazing the power this man has. But don't ever underestimate the power of the market. And they're all business people, like losing money. Consumer confidence is about to hit the mat. It is a contrarian indicator. When consumer confidence gets so low, market tends to move the opposite direction. Again, just look through history. When people are very happy, things tend to get worse. When people are very sad, things actually get better. And imports into the United States. This is a funny chart. Imports in the last 6 months have skyrocketed in anticipation of tariffs. This is actually very bad news because companies have stocked inventory, which means they won't be buying future goods, tariff or no tariff, for some period of time. So the narrative, globally speaking, is Trump could push us into a global recession. That wouldn't be good. Of course, market would fall another 10 or 15% from these levels. We don't know if we're going to get there. We don't know how deep it gets. There is certainly a lot of unknowns. But I will say, from a technical point of view, I just looked at all of our charts this morning, and I share them with you again here. You look at Apple. This is as of Thursday. Let me do a refresh here. Let me just do a refresh. Give me a second, folks. I want to make sure that we're getting good data. These charts should. Give me a second. Give me 1 second. Bear with me. I'll log out. Get back in to that service. 1 second. Sure, we're getting live charts because the market is down today, as you all know. But what matters again was what we own first and foremost. I can't control Trump. I can control what we own. We start with only good businesses. So here's Apple right here. It's down 4% today. Stock's $195. Same price it was back in last fall. That's called support over there. So the stock is trying to dig its heels in. It looks like iPhones are going to become 20% more expensive. Again, if they bring back jobs, if they make stuff in America, blah, 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 tariffs will fall. I do believe it is a work in progress, and what we've heard recently is not going to be set in stone for the future. I mean, these are American tariffs, not Canadian, so iPhones probably become cheaper in Canada. I will say some good news for Canada retail is cross-border shopping just lost its edge, which is actually a good thing, so Canadian retailers will benefit more. So these are stocks we own. We own Apple. We own Automatic Data. Here's a stock holding in very, very well. I see no issue with this company. So this is what matters. This is what we're invested in. This is what I want to pay attention to in times like this. Because lots of unknowns, but this is what we know. So Automatic Data, I'm going to go through quick some of these charts. We own a gold stock. Gold's rolled over a little bit. This beautiful chart, but it too is giving back some ground. Speaking of which, I want to show you something else as we're on a little freeform here today. This is the German index, the German DAX. So people talk about moving to Europe. Money's gone to Europe. Why don't we buy Europe? Right. Europe is down 15% as well. Here's the German DAX index. Look, it was 2,300. It is now 2,000. It is down 15% like goose, just like the broad market here in North America. So they're really, in that respect, not a lot of places to hide. And be careful when people are saying, let's go to Europe and chasing it, only in for a weak awakening. Just yesterday, last 2 weeks, oil stocks were looking very good. ConocoPhillips was a stock I was tempted to buy. Thank God I didn't buy. Look at ConocoPhillips in 2 days, 106 down to 88, which leads me to a few points I want to share with you. Donald Trump, his platform, first thing he said, he wants to see lower prices. Well, that didn't happen. In fact, prices are going higher. He said, I want to see lower oil. Well, low oil just came in. He got that one off his list. Oil's now $67 a barrel. It's $61 a barrel. Wow. Nat gas is below $4. So he's knocked oil down big time, which isn't going to be good for obviously Canadian producers. Here's Suncor. You know what it's doing today. There's Suncor. Wow. Suncor was 55. It's now 47. So if we bought some oil, we would have got our heads handed to us. So oil was looking good. It died. Germany was looking good. It died. So really not a lot of places to hide. Gold has held in quite well. I'll pull up the gold and just gold itself. Here is gold, nice and strong, but it's starting to roll over. We'll see how it holds in. And the US dollar, which has been the place to hide, is this. US dollar down from 110 to 102. That's actually good for the American economy. The US dollar was too strong. So that's going to allow them to export more stuff and offset some of that tariff challenge that they're going to be faced with. Anyways, interest rates. Well, I'll give you the skinny what matters. So Donald Trump wanted lower interest rates because he said they were too high, and they were. US Treasuries, US yields were the highest in the world, which is actually good news. The Fed they raised interest rates in the United States aggressively. That was a big surprise a few years ago, if you recall. So we deal with inflation. They combated that in America because inflation, let's not forget, was it 10%? How high did it get, Jack?
About 9.
We got to 9% inflation. Now it's down to what, 3-ish?
Yes.
So they combated inflation with higher interest rates. Donald Trump said, I want lower rates. I said to myself, who does this man think he is? The bonds trade globally by a bond market. Was that Jack? Sorry.
Same point redacted.
Yeah. This is the US dollar, by the way. Anyways, bonds. The only thing the central bank controls is the overnight lending rate. That's the rate banks charge each other if they want some money, actually, which they do. Banks trade amongst themselves every day. They borrow and lend to each other to square off their positions at the end of the day. That's called the overnight lending rate. Well, actually, the rate that they would charge is a bit higher. Doesn't matter. Overnight lending rate, which equates into the prime rate. That's what the central bank controls. Everything beyond that trades in the market. The market based interest rates on a number of factors, primarily inflation and economic activity and expectations for the future. And the further out you go, i.e. 1 year, 3 year, 5 year, 10 year, 30 year, the higher the yield should be because expectations are harder to forecast down the road and greater chance for risk. Anyways, before the president became the president in the United States, the 10-year yield was about 5%, which was quite high. Coming from a position of what, 1%? It went from 1 to 5. Huge move up. Trump said he wants lower interest rates. He can't control the bond market because it's bigger than he is. But if he creates financial calamity, then the bond market will say we got ourselves a recession, lower interest rates. Money moves into bonds, pushes bond prices higher, rates lower. Bond prices and interest rates are inversely related. So what matters is interest rates went down from 5%. Today they're 3.9, which is huge. The bond market adjusted 1.2% in a matter of 60 to 90 days. Now the central bank that was going to only cut rates once this year, rumor has it they're going to talk about 4 cuts, 3 cuts. So Trump is going to get a second wish, lower interest rates, which is quite phenomenal. All of that plays into the ability now for the central bank to reduce the system. Look, 4-year presidential term, I'm convinced market is higher at the end of the presidential term. 4-year window. And that will, well, if it was under Biden, it'd go by very quickly because it was boring. Under Trump, it's going to be very exciting, dramatic, horrific, and it's going to probably drag on so long. Mind me being a 6-year-old in school, wait for recess, it took forever. We're going to get there. It's just going to be very, very challenging. Go ahead, Jack.
Sure. Thanks, Wolf. If you just pull up the VIX as well. So that's the volatility index. So since we're looking at all these other charts, figured we'd look at that one. So the volatility index. So that is what the market is pricing in for volatility over the next 30 days. I believe that one is. When you have a VIX spike like this, a lot of uncertainty without question. It's trading at 45 right now. Normal for a market is about 20, so it's trading at double what a normal market is. What that is saying is the market is expecting daily movements of 2.5% to 3%, which is quite significant, obviously. So periods of spike like this, you saw it in 2020. If you go back to the financial crisis, you'll see it. 2016 as well. They were periods of opportunity in the long term. And that's what Wolfgang was talking about with entire. So his research, he's a strategist from CI Global Asset Management. What he looks at is how far the market is below the 200-day moving average. So how rapidly the market has gone down relative to the 200-day moving average. And his work suggests that when the market is 12.5% below the 200-day moving average, we're about 10 right now. You have a 90% probability of making money 1 year out from that point. So high probability that the market is higher 1 year out, which I think is very instructive and speaks to, I'm going to say, the mean reversion. So stock markets, when they crash like they have, tend to bop around, and then over time they find stability, reduce volatility, less uncertainty, and like I said, the market is typically higher 1 year out. You only have markets trading at the 12.5% below the 200-day moving average throughout history 3% of the time. So it's very rare for this to happen, but it does occur.
I'll come back then to what Jack shared with you. Again, there's a lot of technical mumbo jumbo we're giving you, probably confusing you. I apologize for that. I'll go back to the VIX. It's a calculation for the price of insurance, looking if the market is interested in going bullish or bearish by the price of puts and calls. I confused you some more. I'm sorry. It's otherwise referred to as the fear index. It's otherwise looked at as a measurement of risk, but when getting extreme, also considered a contrarian indicator. So it's the price of insurance, and when insurance prices are low, as they are over here, the VIX is low. So you can insure your portfolio with options. You can buy puts, you can buy calls, depending on your view of the market. And that's what hedge funds do and traders do. They trade options around, and this is again institutional money that's trying to get cute. Retail doesn't do this, and I wouldn't advise you. I wouldn't dare do this. But my point of the matter is, when insurance is cheap, the market is calm and normal. When insurance becomes expensive, it becomes erratic, which is okay. Now we got a spike. Insurance is expensive. Should we get out? And the answer is no. It's the exact opposite. Once things get stretched too far in the wrong one direction, mean reversion occurs. They tend to go the other way. So Jack explained that same phenomenon with the broad index. So again, here's the S&P 500 index. It's the 500 largest companies in the world. This is the 200-day moving average, this blue line. So that's just the average. That's the last 200 days stock price divided by 200. So it's the average price for the market in the last 200 days. Market's rising, the average goes up. Market starts to fall, the average starts to fall below. Point is, here's the average. Here's the peak of the market. So we've had a bounce back. So from this point to this point, the market is now down about 11%. So from the 200-day average, it's down 11%, 10.5% right now. Sandy McIntyre's work, that strategist that has about 50 years of experience, and I have a lot of respect for him. He's very good. He studies history. He studies facts. He said, this is a point where you buy the market. You don't sell the market. It is so deeply oversold. You have a high probable chance of making money 1 year out. I think the probability is virtually 100% of the time, virtually. We'll call it 95% of the time. This point over here is the same point. Now, that wasn't 200. That's not 10% below. But from this point to that point, you made a lot of money. And so with this correction in mind, this is, in my opinion, once again, not the time to be unloading business stocks. If you have cash, you put it to work. If you have idle money, this is the point to buy or do nothing. Again, doing nothing is doing something. It's doing a lot. This is the weekly for the S&P 500. So there's the market going back 2 years. Here's your trend line. It did break trend without question, and it had a huge capitulation breakdown. Last time it broke trend, it came back. This is a monthly on the S&P 500. This is going back 10 years. That there is COVID. A break below this line is a buy signal, not a sell signal. If you try to sell over here, it gaps up. You missed that point right there. That in itself is about 15% move. That move from 2,400 to 2,100. Yeah, it's 15%. So if you exit here, it gaps up. You will not get that 50% is gone. You won't get it, which is the next point. When the market gets so oversold to such extreme levels, and it could fall another 5-10% from your friends. I'm sorry, it could do that. But whatever we lose, I'm losing a lot of money right now. Whatever we lose in the next few weeks, we should regain very, very quickly. So we have to have faith in the way the market historically behaves. How low can the market go? Well, here's support. So we're at 5,100. Sure, it can get into 4,600. Why not? It can get there. We can't be surprised. But I do not want to get cute and try to exit this position. I repeat, let's just go back to Germany, or I give you many parts of Europe. Look at the correction this thing's already had, Germany. Whoa. You run over here and all of a sudden you lose 50. So it doesn't matter where you go, you're going to get hurt. Doing nothing is the wise thing, because things do mean revert. I'll go back to the names that we hold just to continue. This is very important. This is where our money is. So these are the trends that we need to pay attention to. We don't own the S&P 500. We're not the S&P 500. This is what we are. We have our portfolios. I will say our two quant strategies are holding in very well against their benchmarks, slightly beating the benchmarks. I think, and I can give you the returns as of yesterday's close. Okay, our growth as of yesterday is down 11%. It acts like the NASDAQ. The NASDAQ's down about 15 or 17%. Our balance is down 7. The bonds have worked and helped out finally, because rates fell, bonds went up. So balance is down 7. Conservative was down 4. This is as of yesterday, friends. Our mutual funds are down 2. That's actually the most expensive solution. It actually performed the best so far. Our TSX strategy actually is even. So our TSX quant strategy, even as of yesterday. Guardian, who I have some money with, that's a third-party manager, they're down 3. AGF, which I have some money with, they're down about, 11 and 12%, like our growth. That's a global portfolio. And our other global portfolio, Morgan Stanley, down about 8-9%. And that's a global portfolio. Our S&P quant is down about 8% as of yesterday's close. S&P is down about 11 as of yesterday. So we're basically on the fairway relative to benchmark, relative to indices, relative to other managers. So nothing's off cock here. Again, I continue, if I may, back to the businesses that we own. Amazon. Yes, huge correction, Mag 7. I'm not a fan of selling the stock down here. And again, I can sell any stock I want at any point in time. But I do know I can see a lot of Amazon parcels on my neighbor's doorstep, probably mine, in the next 7 days. I don't want to bet against that. They're going to figure this thing out. Jeff Bezos has direct line to the White House. I don't want to bet against it. We don't have a big position. We have Amazon in our quant strategy. It's not in our growth strategy. We had it. We sold it there. As we sold all the Magnificent Seven in growth, we kept them in our quant because the quant system told us to keep it in based on parameters that we set. It's process, discipline. So yes, we have process and we stick to process as much as we can. And over time, process does deliver results. I repeat, process does work. There's many ways to make money, many ways to quote unquote skin a cat. If every craftsman just sticks to their process, over time they will all do well. Growth manager, value manager, this process matters, and that's what we're not going to change and flip and flop, which is another point I need to raise. Again, the most important thing in investing is coming up with a portfolio that is suitable to your tolerance for risk and meets your return objectives. So it is a tale of it's two sides of the same coin, as we like to say. It must be conducive to your tolerance for risk, but also meet your investment objectives. And again, most of us have all stock. Stocks beat bonds over time, but stocks do correct. Like every single year, they have 10% corrections. Every 4 years, they can have a 25% correction. Every 10 years, they have a 50% correction. That's what they do. And that's the risk and the price to pay for a return twice that of a bond. Interest rates just came down a whole lot. Sorry about that. Interest rates just came down a lot, making bonds a lot less attractive right here on both sides of the border. I'm not sure what the 10-year bond here is in Canada. It has to be below 3% now, probably 2.5%. Here's a stock we own, App 11. It's a gaming stock. It's also a media buying stock, digital media buying around games. The stock is right on trend line now, so it's had a good correction. I'm not a fan to sell this stock, down 50% from peak. Not interested in selling it. I know Fidelity's done a lot of work on it. I know Fidelity thinks it's a very, very powerful company. We have a little position in it in our growth mandate, not our quant strategies. So our mandates, we have 5 and 6 different strategies. They all have a different style to them and a different approach to them and a different tolerance for risk. And that's why it's good to sit down with us and review, your positions and your holdings. SSC-Lavalin engineering firm, slightly below trend. Again, has done that before, gone higher, done it before, gone higher. So again, I'm not overly concerned about it. There will be a lot of building going on, who knows what, but SSC is a larger engineering firm, very, very well managed. Alibaba, Chinese internet. It was looking good, just gave back 12% today. But trades at 15 times earnings. It gets me out of America a little bit. Bank of America, wow, down 8% today. So stock trades at 10 times earnings, pays us a 3% dividend yield. It will grow over time, Bank of America. I don't want to sell these things when they just puke them out. There's no need to. We got a small position every name, couple percent in each name. Don't need to give them away. Don't need to give them away. I don't like them being down here. I know time will solve this problem. Time solves our problem. And if you're 90 and you say, "Well, I don't got much time," you don't need your money then, and your next generation is going to get what you have, and away we go. Here's Bank of America, longer term chart going back 10 years. It has these moves up and down. It's a good bank. Trades at 10 times earning, pays us. So I'm not overly afraid of holding it. Brookfield Asset Management, excellent company, one of the best in Canada. It's on sale. These things should be bought down here, not sold. They manage assets, or an asset management firm, global assets. This stock's held in very well. Bank of New York Mellon, still on trend. It's done very, very well for us. Bookings.com, holding in quite well, slightly below the 200-day. Don't like that, but I'm not overly concerned. It's a very, very good company. Brookfield Corp, this is the mothership of Brookfield Asset Management. Again, down in sympathy with its parent. Here we're getting the best on Wall Street, Blackstone. This company will make us a lot of money. We've done very well with this name in the past. It's paid us some big dividends, pays us special dividends. You're dealing with the best private asset managers in the world with this company. And when this stock goes on sale, it becomes a very, very compelling buy. It's a very, very well managed business. It's going to be quiet with uncertainty. Doesn't work well for these types of business. They have to have their lenses clear so they can see the future to make these big strategic moves. And when there's no visibility, which we have right now, lack of visibility, they go quiet and wait patiently. But over time, you buy a stock like Blackstone, you can compound wealth. They have a 10-year period. Pick your point in the last 10 years. If you bought the stock anywhere over here and you clipped a lot of dividends, you're up 5-6 times your money. I'll take 5 times the money in 10 years. I repeat, a $25 stock after this correction becoming a $125 stock. 5 times your money in 10 years. That's a heck of a return. I don't expect to make that on my house in Toronto from these levels. Citigroup, again, just completely puked. I am not giving the stock away. 9 times earnings, 4% dividend yield. What, banking's over? Stock is oversold, so not giving Citigroup away. Real estate stock, CBRE Richard Ellis, lower rates should help it. High quality business. Yeah, it broke primary trend, as has everything. And again, when you get these primary trend breaks, it's happened before, over here, you get a nice reflexive bounce over time. You know, from here to here is 18 months. Do we all have 18 months? Can you give me 18 months? There's my question. Can you give me 18 months? If you can give me 18 months, I think I can give you a smile. Is that a fair statement, Jack?
Yes, I think, and you saw it on the chart with the VIX, right? Those spikes tend to be temporary. The uncertainty tends to be temporary. Things get less bad over time and markets recover.
Coinbase is our one crypto play. It's not in our quant. It's only in our growth strategy. It's the largest crypto trading platform on the planet. To buy a crypto stock, this is a state-of-the-art company with my kid trades crypto. And if any of your kids trade crypto, I guarantee you they are using Coinbase to begin their crypto trading. They need to go to Coinbase basically to get their chips, so to speak. So 16 times earnings for Coinbase. I'll hold the stock. Again, give me time on this name here, and we're gonna make money on it. It's only in growth. So here's the history of Coinbase. It went public, a little excitement, puke, came back, a little give back. Stock is going to work its way higher over time. I do believe. Costco. Anyone going there this weekend? It's held in very well. Still down. Call it from 1,100. That's down 10% now. Not bad. Last conference call, I said to you about Costco. I do not want to sell it down here. It was 881. I said I'm not selling Costco. I'm not going to sell them Costco. So that name actually snapped back. Money has to go somewhere. That's good. It went to Costco. CrowdStrike Internet Security stock. Best on the board. Don't need to sell it. Cisco Systems, telecom equipment. Support down here. Probably going to get there. So a little bit more pain to be had by Cisco. Not too bad today. Again, the company makes money. 24 times earnings. Dividend on the stock. So we're getting dividends. These are not high valuation businesses. Even crypto, like Coinbase, 16 times earnings. It actually makes money. Like Bitcoin doesn't make money. It uses money to keep it afloat. Coinbase makes money. Constellation Software, nice trend line, high quality Canadian company. It's a consolidator. They borrow money to make acquisitions. Money became cheaper. They continue to do what's called tuck-in acquisitions. So if you're a software company, you're small, a $10 million, $20 million company, you're tired of the business lacks growth, but it's got lots of customers. A company like Constellation would buy you and put you in, make you accretive. They give you a price that makes it satisfying to you and makes their business make a little bit more money each and every year. They're very, very good at what they do. It's one of the few Canadian tech stories I can be excited about. But see how well the stock does at this support, next leg up, support up, support. I think in 5 years this company's worth a lot. The 10-year chart on this Constellation is unbelievable. That's a 3-year chart. Here's a 10-year view on. Look at this view on Constellation Software. Look at this view, unbelievable. Stock was 561. It's now 4,700. It's up tenfold in 10 years. Tenfold in 10 years. All right, maybe it gives me threefold in the next 10 years. I'll take that. That's a third of the success it's had. But unbelievable. That's a beautiful chart. That's a beautiful investment with periods of give back. That's a 30% give back right there. From here to here is I don't know, what's the math? 25% give back. So a little give back, it happens. It is the market. Definity Financial, many of your customers, Canadian insurance stock looks good. Dollarama stock is it's 175 yesterday. Market was puking. It actually was up 10% yesterday because it came out with good quarterly results. It's an expensive retailer. It's expensive for a reason because it delivers consistent results. I don't like the company, but the market does, and so we're long the stock. Descartes, Canadian logistics story, moves freight around the globe. What this company will do is help importers, exporters pay the tariffs. So this company should benefit from all this excess complicated global legislation. It's a freight forwarding company to help you move goods around the world and track them, bills of lading, freight forwarding, tariffs. That's what it does. It's a software company, high quality business, expensive, but high quality. And it's Canadian. It's hard to find stuff like that in Canada. Duolingo, it's an app, stock holding and wealth, language software. It's a benefactor of artificial intelligence. It's good software. It's fun, and it's sort of out of the crosshairs of everything. And that it's not, affecting global trade. It's software. It makes money. It's only in our growth mandate. Pipeline stock in the United States, oil just came down and got whacked. It pays us an 8% dividend. Nice trend line. It broke it today because oil's down today. We have very little energy in our portfolio, so we're not going to go zero weight energy. Fairfax Financial, insurance stock, Canadian, beautiful chart. Prem Watson runs the business. Again, I'll give you a 10-year chart, extend time horizon. Nice move. Stock back here was what, 400 or 500. 10 years later, it's 2,000. I'll take that. That's a four bagger, 3 times your money. It's a nice trade, or nice investment, I shall say. Telecom equipment maker. We've held it down. Support here. It's just nuts and bolts type business. Trades at 24 times earnings. Not expensive. Digital payment company, back office processing, credit card, blah, blah, blah. More digital payments, less cash used, more online shopping, more. Company makes money. It's on trend. No trend broken. Internet security again, at support, bouncing, holding this level. Hopefully it holds it now. Boring company, nothing exciting. It works. It makes money. Here's a name I don't like. I didn't like it when I bought it up here, and it kept going. Now it broke. Gildan Activewear, underwear. Where they make them? Is it Taiwan?
Some of them just got tariffed.
They got tariffed. So they got a wedgie on the tariff. I don't know what to do with this one. I'll figure this one out. But it's cheap. It is cheap. It's Canadian. Decent brand. I'm not a big fan of underwear makers. I don't know how much more downside the stock has at these levels. At 16 times earnings, pays a dividend. It will be okay, I think. I'd probably rather maybe I could sell it by Nike because it got absolutely clobbered. But again, I don't really want to move around a whole lot. That's the issue, because if I sell something so damn low and buy something that is working, the thing that's working probably stops. The thing that's low probably snaps back. So out of the frying pan into the fire is my fear in such a volatile environment. So really, I'm just trying to suck it up, Buttercup. That's what I'm trying to do. There's Gildan's long-term chart. Not great, not bad. It's interesting. So I guess one idea. It's in our TSX strategy only, I think. Google, boy, it became cheap. 18 times earnings. Company makes $100 billion a year. It'll make about $2 billion this month. Here, I'll show you Google. Let me show you some on Google, just for fun. Alphabet. So here's Alphabet, Google. Here's the revenue for the company. Sales in 22, 282 billion, 307 billion, 350 billion, 388 billion, 430 billion, 478 billion. Every year sales go up, what, 10%? Free cash flow, call it earnings, net income. We'll go to actual pure income after taxes, 60 billion. Next year, 73. Last year, 100 billion. This year, 109 billion. Next year, 122 billion. 136. Oh my goodness me. Canaccord is worth about $1 billion. So they can buy 100 Canaccords. They can each year almost buy the Royal Bank for that money. Wow. Your Royal Bank is about what, 150 billion? What's Royal worth?
Something.
Just for fun. Royal Bank's 158 billion, so close enough. Yeah, so Google can basically buy Royal Bank almost once a year. I don't want to bet against that stock when it's down so much. For whatever reason it's down. It just doesn't make sense. ESG score. Okay, here's something for you so you can know. This has gone dead. This is, I'm not going to call it woke, but ties into woke, but it's not. Environment, social governance. That was all the rage during the bull market. In a bear market, that gets thrown out the window. But what doesn't get thrown out the window is the cash that Alphabet will generate. If they split the company up, antitrust, call it what you want, probably even better for the company. The street thinks the stock is worth 217. The street's got a buy rating on it. I'm not interested in selling it. Like Microsoft, which we don't own, is a similar story. I'm actually tempted to buy it and lean into it. I'll give you the math on Microsoft. Let's go to the earnings again on Microsoft. Net income, no different than Google. 72 billion last year, 22, 23, 2 years of 72 billion. Last year, 88 billion. This year, 98 billion. Next year, 111 billion, 130 billion. Like, that's why the Magnificent Seven are the Magnificent Seven. That's why so much money went there. And they're not super expensive stocks. They're trading at, but 25 times earnings for a company that, wow. So we don't want to give this quality stuff away. I don't own Microsoft, by the way, so I'm actually tempted to buy the stock. Now, we don't have any cash. If I sold something, would I buy it? If I needed it, I would. It's a good name, to make a long story short. And it's actually digging its heels in here on a technical basis, as you can see. Growth trend lower. Here's a monthly on the stock. How much lower can Microsoft go? Probably to the lat number, 3/4, maybe 10% more. But look at the long-term trend of the stock. If you bought this stock 10 years ago, Microsoft, it was 40. Now it's 3. Let's say it goes to 340. 10 years, that's a fantastic investment. But you got to tolerate that. And if you don't like this and get out here, you miss the bounce. And you see the bounce. It does happen. These are monthlies. So each one of these is a month. So that's about 6 months of time in there. You go to, and again, you can see when these things do, have these reflexive bounce. That's a daily chart, friends. I go back to our investments that we own. Goldman Sachs, smartest man on Wall Street, once again tied up with Blackstone. I'm not giving the stock away. 11 times earnings, 2.5 divvy. Trust me, they're financial engineers. Trust me, they will learn how to make money. They got the presidents here. Away we go. Here's a stock that went out of favor that I said I'm not selling it because it's a quality business. Is Ontario Hydro. So when the people want safety, they run into this. We've hung on to the stock, didn't trade it, held it. We bought it over here somewhere and held it. Got our dividend of 2.5%, which is small. Stock's expensive. I'd actually be a seller of hydro in here, but I'm not doing anything. But that'd be a stock I would consider selling, but I'm not. Here's a name that's held in very well. Hermes luxury item. This is it in our quant or is it just in our growth? One or the other. Stock's held in very well. High-end luxury brands, tariffs are going to be hit on it, but it's not, its exposure is less, I guess, to America. So it's held in very, very well. People do have money. People want to make themselves feel good. The rich are still rich. That's what it targets. If people want to have nouveau rich, we'll buy stuff like this. A big margin business. Robinhood Financial, call this fintech, financial technology, disruptive a little bit. A cool company because you can trade crypto and regular assets on the Robinhood platform. I don't trade crypto assets. My kid, as it trades crypto, you have to trade on multiple different platforms. Robinhood sort of brings it all together. Very cool company. Trades at 21 times earnings, has much better growth than a typical bank. Stock is corrected almost 50%. I'm not a seller down here. It's a good quality, real business that's growing. Aerospace company, showed this name before. Nice young trend, came back a bit of ground. I think just because it's a source of funds. Sometimes the winners get sold just because you have to. You sell what you can, not where you want to sell at times. But it's still on trend, nothing wrong with it. Again, it makes the air landing gear. Interactive brokers, little breaking through there on it. Again, online trading. So if any of you guys want to fire me, you can do that. And you want to do it yourself, you go to Interactive Brokers and open up your account there and spend 50, 60 hours a week. Well, we spend about 150 hours a week looking at your account because there's 3 of us looking at it all day long. So 150 hours a week is what we spend trying to make sense of the world. Intact Financial, insurance stock. Clean, clean, clean. Nothing wrong with it. Hotel chain, best in the world. People are going to stop traveling? I don't know about that. I need to travel. I need to travel more. So hotels are expensive. They're very expensive. It's a good margin business. It's also a franchise model. It's a capital light model. It's an accretive model. It's a high gross margin business. So again, you buy these things on sale, you do well. You just don't sell them down here. High quality brands, as you can see. Surgical robotics, I think made in America, so I don't think it'll be affected by tariffs, I think. State-of-the-art stuff. Again, I sit on a hospital board for Humber River. I'm on the philanthropy board, and they have ISRATs in the hospital. Every procedure requires $2,500 worth of stuff. So it has an annuity, guaranteed recurring revenue. It's a growth company. JP Morgan, best on Wall Street. I said that about Blackstone. I said that about Goldman Sachs. They're all the best. They're three very high quality businesses. So is Morgan Stanley. You're like blue chip of blue chip. Gold stock, Kinross, we own it. Gold maybe is losing a bit of its luster. Gold's had a great move. It's had a great move. I would not surprised to see gold pull back. Nothing goes to, trees don't go to the sky. And when something goes too far one way, the pendulum takes the other. And everyone wanted Bitcoin at what was Bitcoin? 107,000 is now 80,000. Couldn't get enough crypto at 107. And now it's 80. No one wants it, but they want it at 100. No one wanted gold 10 years ago. Now they want gold. 10 years ago, by the way, gold was about 1,500. In the last 10 years, gold basically doubled. When I came to Canaccord, gold was about 1,400 an ounce. It's now 3,000. So our accounts have done much better than the commodity has, the yellow shiny metal, in the last decade. But gold's been very hot. The good news for the miners, I will say, because they have been not left for dead, but they didn't participate as well as a collective, as well as gold has. The good news for the miners, if gold holds this level of around 3,000, the miners that are now actually a lot bigger companies than they were 10 years ago are in financially better shape, but the cash flow they're going to spit out is enormous. But the market knows that. That's probably why they're selling. But they are set to make a lot of money. I think Agnico Eagle is probably scheduled to make, I'm going to throw a number, maybe $1 billion this year. We own that, by the way. Pipeline in Canada, they collect the liquids, move them around, 5 dividend, on trend, no worries. MasterCard, I don't know, it is what it is. High quality business, digital payments. I use it every day. They get a little clippy poo every day. On trend, down from 580 to 5, down 15%. It's on sale. And I guess it's Warren Buffett. Whenever anything is on sale, people buy them. People have been hoarding, as we showed you the hoarding chart, in anticipation of a tariff. But people, what we do when it comes to financial asset stocks is we buy them when they're expensive and we want to sell them when they're cheap. We never, as retail people never buy stuff when it's down. They do nothing when it's down, or they sell when they're down. What people do is they buy when it's up. And if you buy when it's down, you make that much more money. But doing nothing is also like buying at these levels, in my opinion. So if you have cash, put it to work. Give it to us. We'll make you money. You just don't sell down here. Marriott, another hotel chain, digging in its heels finally. Franchise model, gross margins high quality business, gotta travel. This is Latin American internet. It's their version of Amazon in Latin America, 50 times earnings. So I'll tell you, it's Amazon's probably 35. It's actually more expensive than Amazon, which is interesting. Net, I think the street sees it as a place as a safety zone. You want technology. I think the world is going to start to accept technology from China, accept technology from other parts of the world. And as we all know, China is coming out with some very, very, very cutting edge technology. So maybe part of that, dominance of America's tech is going to get spread around the world. I would not be against that one iota. I will share with you as well, U.S. economy is 25% of the global economy, but the U.S. stock market is 50% of the global stock market, give or take. So it is interesting, that factoid. I don't really know what to do with it, but I share that with you. The U.S. is 25% of the global economy, but the U.S. is 50% of the U.S. stock market, or of the global stock market. Meta, that's Facebook, held trend forever now. It's maybe giving back some ground. 20 times earnings for a company like, I don't know. I see a lot of people on it. It's an advertising machine. Do we want to look at how much money it's going to make? Why don't we do that? Is it a real business? Is Meta a real business? What does it do? Let's just take a look-see-poo. Let's just take a look for fun. Meta. In 22, 116 billion sales. Salesforce did well, 134. They got their bonuses. 24, $164 billion. 25, that's this year, 188 billion estimated. Next year, 214 estimated, and in 27, that's 240. These numbers will come in, give or take. As you can see, they had these previous estimates over here. They missed in 22, but 23 they beat, 24 they beat. They tend to beat estimates, 3 to 4 times. Let's just look at the net income. This is the most important. How much money does this company make? Well, in 22, it made 23 billion. That's a billion, it's a billion every 2 weeks. In 23, it made 40 billion. And last year, it made 60 billion. This year, it's going to make 65, so the growth isn't as exciting. Next year, 75. And in 27, $85 billion. That's a real business. They can do a lot of things with $85 billion a year. Think about it. $85 billion a year. That's a half a Royal Bank they get to buy every year. Every year. I don't bet against that. It trades at 16 times earnings. This is not expensive technology. In 2000, you couldn't find a tech stock that traded at those valuations. So again, it's an advertising machine, it's an activity machine. Who has Instagram? That's Google, correct? It's Facebook. Yeah, and so Instagram, Jack just did some math on that. That's worth, how much was your cost? $500 billion?
No, it's YouTube.
YouTube. Google, YouTube, correct. So if Google gets spun out, if Google gets broken up, i.e. Alphabet they call it, if they break that puppy up into parts, perhaps YouTube is a standalone, it's valued at $500 billion unto itself. So that would be a good thing. Back to what we own. Where's our money? It's in Manulife. All right, it's finally cracked. It's been strong, but 45 to 40, not bad. 4% dividend, 14 times earnings. The insurance stocks have held in very well, much better than the banks in the last couple of years. They continue to benefit. Interest rates are going to get reset. That'll probably further benefit the banks. Maybe the banks got a bit of a run in front of them over the insurers. Does that make sense to you, Jack? If rates get reset, it'll favor the banks a little more, right?
Yes.
The yield curve
Steeping yield curve.
more, yeah. We can talk about that if you guys want. There's Morgan Stanley at par. Total buy at this price. I said total buy at par. Mark my words, in 2 years, you'll see $150 stock on this. I think Morgan's $1.50 in 2 years' time. And you get paid 3.6 while you're waiting. Internet security, ad support, big correction. Any crypto website tends to be powered by the company of Cloudflare. So I like encryption. I like internet security a lot. I think it's an amazing space. Netflix, boy, oh boy, is that strong. Holding real well. So I need some content this weekend. I need some really good content to take my mind off of things. I hope I can find something on Netflix. I need my Netflix. Yeah, you know what's been working, friends? I'll tell you what's been working. Fox, smokes, and booze. That's what's been working. O'Reilly Automotive, car parts. Imports become more expensive on automotive. Used cars stick around. Here's a stock making 52-week highs. We found one. Holding this for a little while now. Nice name. Car parts, 35 times earnings. So it's not cheap, but it's working. Again, telecom equipment, internet security, real business, a little expensive. I may have to punt this name. We'll see. Palo Alto Networks. It is when the space works. The thing is a very, very good business. It does work over time. So again, I'll give you a 10-year chart on this company. What's wrong with that chart? 10 years. You would have bought the stock, call it at $33 becomes 185 in 10 years. Now 150. So $30 becomes 150. That is 6 times your money in 10 years. So I would expect, similar results the next 10, give or take. Even cut those results in half, I'll take them. You will too, be very happy. Ralph Lauren, excellent brand. Tariffs, stock's up today. So found a bot's good news. I'm looking for some. We'll find it for you if you spend time with me. High quality brands. I love brands. 18 times earnings is cheap. Big margin business. All right, let's just look at it. There's Royal Bank, 180 to 160. I don't know why. Pays you dividend, leave it alone. We're going to make money with the Royal Bank in time. Charles Schwab, again, if you want to fire me, you can go to Charles Schwab. Trades at 23 times earnings, pays you a dividend. Nice name, I like it. Great commercials that they're running. Spending a lot of time on the money on those commercials, but it's good ads. Stock's held in reasonably well. I'm good with it. Shopify, one of the few tech darlings in Canada, gets you set up if you want to do some e-commerce. Very, very good business. Again, tariffs being affected, trade being affected. It's a volatile stock. It's not in our, is it in our TSX quant? It's in our growth mandate for sure. Probably our TSX quant has it as well. So there's not a lot of technology to buy in Canada. Descartes, Constellation Software, Shopify are the three best tech stocks in the Canadian marketplace. So money needs, when Canadian portfolio managers need to have some tech to be index representative, they're going to go to the go-to names. Shopify is one of them. They took the stock down 20% yesterday. No need. The business has not changed by 20% as far as I can see. Could be wrong. German company, money's going to Germany. I bought Siemens, nice. Well, it came back too, but it's still on trend. So we got a bit of money in Europe. We have a little bit of money in Asia. We have a little money in Latin America. We have money in the US. We have money in Canada. Here's Spotify, unbelievable business. $100 billion company is worth 100 radio companies, in my opinion. It's incredible. Look at the trend on Spotify. Radio. I used to be in this is my old business, and it was free back then. People are paying for radio. And back then, people said people will never pay for radio. Want to bet? Look at that, eh? What a chart. Just a 10-year chart would be nice. Let's just take a look at Spotify. So we own this, not in our quant. My God, 10-year chart. 10 years ago, it was 200. Now it's 500. Not bad. We got a double on that. Not bad. Volatile name. And at the bottom, obviously, huge move. I just look at 10 years ago. Actually, stock hasn't been around for 10 years. So it's been around since 18. I remember hearing about it at a Boston conference at Canaccord does. AT&T Telecom Company, big juicy dividend, so out of favor. We bought this bad boy right. I'm guessing we bought it over here on the turn and hung on to it. So it's been a safety trade and it's been holding in well, giving back today, as is the market. Tencent, Chinese internet. Again, a lot of good technology coming out of China. I don't mind having a few positions there. So we have Alibaba, we got Tencent. Don't mind a bit out of North America. Stocks holding up fine. Atlassian team, it's software for programmers. Programmers use this to collaborate. They can work internationally. Offshore can connect with one another and work on programs together. It is state of the art. It's a very, very good, well-run business. It's got good growth momentum to it. Again, it's in our growth strategy, not in our quant strategy. Again, you see in our growth strategy, we'll buy stuff that is not making money yet, but is soon to become profitable. TJX, want a deal? We talked about this in the last conference call. Stock on the last conference call was 112. Today it's 127. So again, it broke trend. Don't sell it down here. You can hang on to it as long as the business is sound. It's a great company. Hudson's Bay, all that inventory will be bought by TJX. Mark my words. That's what they do. They buy distressed inventory at a good price. Then they clean it up and put it on the shelf, and it becomes a bargain. The $300 dress is $90, and whatever they sell. People like going. It's making an all-time high. TJX winners. U.S. energy stock. It was working until oil got knocked down. Pays a dividend. Drill baby drill is why we bought it. They want to onshore some energy. Oil doesn't look great. We got a couple of oil stocks. We're very underweight. Got to be there. With some, I believe, is too big of an important of a sector, because when they turn it back up, they turn it back up. Target, we got ET. TransCanada Pipeline, dividend, Canadian, 15 times earnings. They don't build a lot of pipelines. Takes a long time to build a pipeline. Real business. Deleveraged, sold some assets. Pretty good business. Not exciting. Should be pretty stable. Visa, like MasterCard, on trend, digital payments. This one's amazing. It just made a new high. VeriSign, it's basically your internet website management, getting your browser, getting your domain name and all that good stuff. Boring company. Very predictable, very stable. Garbage, the unbelievable industry. Remind me to buy garbage when it's down. I can show you 3 garbage stocks, and the 10-year return is unbelievable. And that's if we all think 10 years out. Sorry guys. What am I doing wrong here? My mouse ran out of the fridge here, folks. Update. Garbage, Waste Connections. Again, we own the stock. Here's a 10-year chart on this company. Honest, this name, you buy it at me, I gotta buy it down here every time. Down on the breaks. Because you get an outsized return. But even if you buy the peaks, you make money. If you bought the last peak, you're up. But if you buy the breaks, you make a little more. Stock's expensive. They're always expensive. And that's why, value managers wouldn't buy the stock. But you know why it's such a great business? Because it's so predictable. They grow every year. They got COLAs in place. They're contracts with the city, which means they always get paid. They always get paid. So they got no bad debts. It's a boring business, and boring businesses are some of the best businesses to buy. Again, 10 years. The stock was 50. It's now 275. What a rate of return. You had to pay your dues. The dues are the give backs. Should I sell it? Should I sell it? Oh, is it all over? Too expensive. All the reasons why you want to sell it. That's COVID. All right, we're staying in, no more garbage. No more garbage in COVID. Garbage is over. Yeah, we're all green. All right. Stock in COVID was 97. It's now 275. Wow. Walmart, again, last conference call, Walmart was right there at 83. It's 86, fine, whatever. One heck of a business. Sam Walton would be very proud. So down here, I'm not selling Walmart. People want a deal. They will find ways of buying around, minimizing tariffs, doing what they got to do. They're very smart logistics companies. They know how to get around stuff as well. What company went into U.S. with their imports? Maybe my wife maybe told me this. A company used to import all this stuff into the United States, into Canada, because there was no tariffs. Now they're just rerouting it directly to Canada. I don't know what company that was. It was an international player. They used to first ship all this stuff to North America, i.e. US, and then from US to Canada, because it was free. And now it's being tariffs, so no problem. We'll just ship direct to Canada. So there are ways around some of these roadblocks that the government is putting into place. Toronto Stock Exchange on trend, no need to sell it. The Xylo real estate, disruptive. I like disruptive businesses. Bookings.com, disruptive. Interactive Brokers, disruptive to financial, and Xylo, disruptive to the old real estate model. So good business. Lower interest rates helps it. Holding in very, very well. Price compressed, and there we have it. So, friends, I go back to the asset mix you have is one that has to reflect your comfort level. You do not make big abrupt changes in the middle of a crisis. Your comfort level has to be predetermined, preset in good times, normal times. And I speak to all of this. Look, the market will fall 25 to 50% at some point. Can you tolerate that? If your account goes from 10 million to 7 million, are you going to be okay? The way we retire in a really good position, and it's we're all of us are in the top 5% of the world. We're the 5% crowd. Maybe not all the 1%, but certainly the 5% crowd. The best way to retire is with twice as much money as you logically, realistically need. So twice as much money, because that way, when you get the 50% pullback, temporary, as they all have been, you're still okay. If you retire borderline just enough money, then you set yourself up for problems of yourself because you mark it down 30%. You can't take it anymore. You think it's going to fall another 50, and you sell only to watch the market turn higher. So the 4% rule, if you're retired, the 4% rule, call it the 5% rule, somewhere in between. If 4%, if your assets are such that you can live off of 4% or 5%, you will not run out of money as long as you maintain that level. And you can take out money when the market's down at these levels on a monthly basis at the 4% rule, no problem. Even though it's down significantly, selling a little bit down here is not going to affect your portfolio on iota. Taking out big lumpy amounts down here, different kettle of fish. So again, friends, these are challenging times. They will pass. This is not as bad as COVID. This is not as bad as the financial crisis. But it's remarkable that I'm going to say Trump is like a globetrotter. And I saw a parade in Germany, I think during Oktoberfest or whatever it was, with Trump on a float, and he was giving the world the bird with his index finger and spinning the globe around it. He has the world spinning. We all know that. Everyone is fearful of him. He's the ultimate bully. He's being respected and heard, but people have moves too, and everyone is going to take care of their best interests first. All of us, that's what we do. Our best interests first. Now, I don't want that getting extended. Friends, I have a fiduciary duty to take care of you first. And we both, I'm an accredited fiduciary. I don't pay my dues anymore, but I am an accredited fiduciary. And it's all about you taking care of you. And that's why I'm doing this call, to take care of you and give you sage, sound advice in the times when it's needed the most, which is in the middle of a crisis. So again, it will pass. I like the work Jack gave us with Sandy McIntyre when the market is oversold to the point it's below its 200-day moving average. That's the average price of the stock over the last 200 days by more than 10, 11%, call it 12%. You have a very good chance for a snapback. My guess is, I don't even know what the market's doing right now. I don't want to look, but I will look. My guess is market's probably down again on Monday because of people who haven't sold, who are just biting their nails on the weekend. They'll take in more bad news. They'll read papers. They won't be able to take it anymore. They'll want to feel like they want to vomit. They'll probably sell more on Monday. I would then expect the market to turn on Tuesday. But again, my short-term calls are going to be wrong. My long-term calls, I think, are going to be right. So I think I have a very high probable chance of being right in the next 5 and 10 years. I have a good chance of being wrong in the next 2 days. I think by the end of the year, we'll be in better shape, I hope. I do think by the end of the presidential term, we're going to be higher. So we're in it. This is not the point to exit. I did a few moves I will make in the next few weeks, but again, I want a stable footing and a bit of clarity. Until then, I know the business we own, for the most part, all make money. They're all excellent brands. We're diversified, and we're paying attention. I'll throw it back to Jack for any final thoughts, Jack, on top of what I
Sure. Covered a lot there. Obviously, in a very volatile time. When we do run financial plans, we do incorporate these periods of time, 4 or 5%, as Wolfgang mentioned. It's very important. Just like people dollar cost average into investing, I think dollar cost averaging out during retirement is very prudent. And the financial plans that we run, they all work at those levels, and they do incorporate these temporary times of stress. We don't know when they're going to come, but we know based on history, they do arrive, periodically, every 2 to 5 years. Last time that we had an experience like this was 2020 with COVID. We remained positioned for the recovery, and that's where we are now. We went through the stocks, we went through the charts. They're good companies, not expensive. And when the market turns, obviously we're going to make some changes between now and then, but we do want to remain positioned for the recovery so we can stay on our long-term plan for returns and obviously take care of you. But if you have any questions, let us know, and we will be reaching out individually over the next couple of weeks as well.
Friends, I'll show you one final chart. And again, this is the S&P 500. I can give you Canadian market will be the same. Here is a 45-year chart. It's a long time. So again, all of you remember the 87 crash. Okay, the 87 crash. I'll make this chart even bigger for you. There you go, make it even easier to read. I ask you quickly, where's the 87 crash on that chart? How quickly can you find it? I'll find it for you. It's right there. That's the 87 crash rate. Dramatic. I remember that day clear as I don't know, clear as whatever. Clearly, I do remember that day clearly. I remember going to my doctor because I had an appointment with him that day, and I was, I don't know, 87. Was I 22? Yeah, I was in university, and so of course I was paying attention to business. I said, "Are you worried about the market?" And well, I am. My retirement account, blah 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 blah. Well, the doctor ended up living for another 15 years. I do think he ended up committed suicide, and he kept working. He never stopped working. So he was worried about the market, but completely unfounded for the type of person that he was. Again, look at the market back. The market back here in 81, the S&P was worth 132. It was 132. Today it is 5,200. So that's up almost 50-fold in a 45-year period. I do expect, and so I'm not going to be around for 45 years. No, you're not, but your kids will. And how many of you are going to give your kids a big chunk of money down the road? So their time horizon is long. We have many clients who think that way, who are in their 80s, say, money's not for me, it's for the next generation. They're in their 30s and 40s. Yeah, they got 40 years. This is what I would expect. But again, let's go through. There's the 87 crash, which was obviously fixed. Let's go to TechRec when I joined the market. I joined Wall Street, Bay Street right here. That's when I joined Bay Street. And that's a little more pronounced. And the market had a very good correction then. That was about 50%, 1,500 down to 800, almost a 50% correction. Right, that happened right there in 2000. Then it went higher, only to go lower in 9/11. Excuse me, financial crisis. I apologize. There's your financial crisis. You can't trust America. It's all over. What do they do to end this financial crisis? They lowered interest rates and they printed money and bought back bonds. But very complicated, but not real. Well, lowering interest rates isn't complicated. So the white knight came in, and there is a white knight waiting in the stable, waiting in the barn, and it's called the central bank. Interest rates are not zero. If there is zero, I'd be very worried, because that means the central bank has no bullets to put in the gun, no bullets for the chamber. Interest rates are high. They have a lot of room to move. They can jam so much money at this economy if it really goes into a depression and reignite it. Gasoline is available to throw on the fire and reignite. It doesn't take much of a fire if you have a bunch of gasoline to create an inferno. So here's a financial crisis. It passed. Let's go into the European debt crisis. That's right here. All right, let's go to COVID. That's right here. Look at the market. So now we have the Trumper. Thank you, Donald Trump. That's him right there. Best president ever, biggest crowds ever. Yeah, biggest stock market correction ever too. Yeah, ding that. Sorry, Trump lovers out there. I don't think any of you guys like Trump, but you might. That's fine. Anyways, this will pass. How much lower, I don't know. You know, there's good support right there. That's 4,800. So another 5% maybe lower. I don't know. But again, what Tony Dwyer said to us, and Jack resonates with Jack. Well, what we lose from here, we will gain back very, very quickly. Markets do go up fast as well, especially when they get so deeply oversold. So we're getting somewhere. Give us some time. We will get through this. Mark my words. If you have any questions, want to do one-on-one, want to come see us, we're always here for you. You know that. And I want to thank you for your time. And again, any questions, let us know. Final thoughts, Jack, for the final?
No, I will be reaching out, and I'm sure Wolf as well. Just touch base with clients.
Yeah. Jack's been doing a very good job, making sure you guys are good, reaching out to you. We're here for you. Please, anything we do, let us know. I do wish you a great weekend. We will worry for you. So I ask, worry a little less. We are worrying for you. So compounding the worry isn't going to help any of us, but we're human. Cut me and I bleed. On that note, I do wish you a great weekend and thank you.